Are you ready to take your first steps towards financial freedom by investing in property? Whether you're a first-time investor or you started your portfolio but need some help continuing to grow, 2022 REB Buyers Agent of the Year and Rising Star finalist Lachlan Vidler and his team at Atlas Property Group are here to help. As experts in property investment, Lachlan and his team are ready to help you take your next step in growing your portfolio. By completing the research, sourcing and negotiations, Lachlan goes the extra mile to find you a high-performing investment property. Visit atlaspropertygroup.com.au to book in your discovery call absolutely free of charge.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? It's Phil Tarrant here. Hope you're well. Host of the Smart Property Investment Show, trying to navigate this particular property market, trying to host the conversations with people who seem to know what's going on in relation to tracking, capitalising from or responding to current market cycles. We've had a lot of property investors on recently who are sort of expressing their concerns around investing in this market. You only need to pick up a paper now and you'll see that there's a big question mark around property, and you see how quickly the media can change its tune in relation to properties running rampant and property prices are unsustainable to property prices in free fall. Where does the truth sit? Somewhere in the middle, no doubt, but we'll continue to have these discussions with people right across the property ecosystem to help you make more informed investment decisions. And back in the studio with me today is a couple of the good friends of the Smart Property Investment Show. We have them on a regular basis. For me, it's a bit of a pulse check for the market to see what's happening as we do try and narrate the changes in property markets and how to position yourself to capitalise on it. Our friends over at OpenCorp in the studio with me today, Matthew Lewison, CEO, and Michael Beresford, he's the Director of Investment Services. We're going to get stuck into it. And sort of the big headline banner for me around this particular chat is there a smart way to buy in a cooling market, or are we actually in a cooling market? And what do you do about it? How do you capitalise on it as property investors? Because no doubt these two gentlemen will tell us that it's probably a pretty good market. And I'm just probably paraphrasing what they're going to say, but no doubt there's opportunities. Gents, how you going? You well?
Yeah, great. Thanks, Phil. It's good to be here again. Good to be chatting.
Good to see you, Phil.
Yeah, good guys. And last time we got together, I think it was late April this year, and we sort of check in on a quarterly basis. And I'd be interested to go back a year from now and pick up where our chat was. And we're talking about how markets were rocketing ahead, price growth never seen before in many markets, 20+% Sydney and Melbourne, Perth starting to fire again. And now coming off the back of the federal election, hyperinflation, wars in Europe, the brakes have been tapped definitely on property markets, and we're already talking about significant price drops. So I want to get some sense for this cooling market and what you actually do in a cooling market. But I note, Matthew, and no doubt it's probably the highlight in your household when census data gets published. No doubt you pop open a bottle of champagne and go, this is the most exciting week of my life because I get to pick through numbers for the next couple of weeks. Any big headlines for you in the census data? Because no doubt it'll give us some clues to how property markets might move in the future.
Yeah, that was a sleepless night for me, Phil. I was up all night combing through the data.
It's like these gamers that have to take days off work because the new game's coming out, right? You're the same.
That's right. I've got a special chair when the census comes out. So a couple of the big things that really stood out were largely around incomes, and a few areas there. One was that household wages household incomes across Australia grew by more than expected between 2016 and 2021. So they actually went up 22% in that period of time. And that was far more than inflation. And that was a big surprise to a lot of people. Because again, if you think about different drivers of property prices, we know that it's supply, demand, and affordability. So when wages are going up, then obviously that helps to support higher property prices. The other was just the geographic spread of wages. And obviously Sydney, one of the highest household incomes in the country. Big surprise was Perth as well, was a lot higher than many of the other capital cities. And incredibly, when you look at that from a housing perspective, the proportion of a household's earnings that are getting contributed to their housing costs, whether that's rent or mortgage, is about half in Perth what it is in Sydney. So on a like-for-like basis, somebody in Sydney is spending double the amount of their earnings on their household, on their rent or their mortgage to what somebody in Perth would be spending. Their incomes aren't actually that far apart. But again, that kind of talks to the fact that Sydney's property prices are double what they are in Perth, despite Sydney's wages being marginally higher than Perth's average household wages. So again, it kind of just talks to the fact that it's really important to understand what are those drivers of price and affordability. And there's heaps more to continue to get through. We've only seen a small snippet so far from the census. It's going to continue to come out over the course of the year and next year as well, as they start to consolidate that data. But that's some of the big takeaways for me.
Yeah, it's interesting because you look at and there's so many ways you can slice and dice it, but just that particular theme that the wages sort of parity between Sydney and Perth, however, property significantly cheaper. There's hence a reason why probably jet ski sales and Ford Ranger sales are the highest over in Perth, because, you know, when you look at the aggregate, there's a lot more workers in Sydney than what there is in Perth. But when you look at the type of work people do in Perth, they're typically higher paid jobs in the mining area, larger disposable income. So just looking at that as a particular point, you would say, well, there's a lot more disposable income out in Perth. So should that put upwards pressure on real estate? And we're sort of seeing that take place.
Certainly. I mean, there's a huge undersupply of housing in Perth at the moment. We've seen vacancy rates sub 1% for, I think it's about a year and a half now, 2 years, which has obviously been driving up rents. We saw 15% rental growth in 1 year alone. So that obviously suggests that there's still probably plenty of room for rents to go up further, because they're still not above what you would be paying in other capital cities. It's still relatively affordable by Australian standards. And I mean, that you look at the yield for an investor in Perth is phenomenal compared to a Melbourne, for instance, or a Sydney as well. So all very important to understand kind of how people are going to be able to pay their rent, because if they're at their limit, then you're not going to get much more rental growth, even if there is an undersupply. But if there's capacity to pay more, then obviously that bodes well for landlords, I suppose, not so much the tenants.
Yeah, I'll let you know. I'm sure, I mean, you could talk census data all day, but our theme today is it smart to buy in a cooling market? And I guess, Michael, the best thing for us to do would be to actually define what a cooling market is. Is that just simply there are less buyers, or are prices really falling through the floor? Can you give us some sense for it all?
Look, I think just like, a cooling market is a very general term. And, we've spoken before on this podcast that one of my favorite things to help investors understand is, what's actually happening or what's behind the headline. So the cooling market and house prices dropping is something that sells papers. But as Matt's talked to already, there's not one housing market in Australia. There isn't even one housing market within Sydney, for example, or Melbourne or Perth or anywhere else. So there are different dynamics that make up these things. So while, prices will be coming backwards, being the reporting, absolutely, that's not happening in every single area. And there are opportunities that are really well positioned from a growth perspective, which is what we look to focus on. So just in a moving market, there are some markets that it makes sense to be buying into as an investment and areas to be steering clear of. Exactly the same applies in what's generally termed in the media a cooling market. So what I thought might be helpful, Phil, is if I just talk to how these things are measured and what exactly is a median house price. So the median house price is the only metric that is recorded when it comes to house price movements in Australia. So, to be really clear, if the paper says Australian house prices have grown by 15%, that means that the median house price across Australia is 15% higher than it was 12 months ago. Now, the median is often confused as being the average, which it's not. It's actually the middle sale in a distribution of sales. So if you have 5 sales and you line them up from the cheapest at one end to the most expensive at the other end, then the third sale is that middle value, which is the median. So just because a median moves up or down doesn't mean every property has made or lost X% of value. And, the opportunity for investors right now, as Matt was talking about with supply, demand, and really importantly, the third one, affordability, just because the median comes backwards doesn't mean that there isn't significant demand at the affordable end of the market. So, let's take a couple of markets, for example, down here in Melbourne where we are. Toorak is kind of the Mossman equivalent, super top end, very blue chip, since interest rates started to come down, their median house price has dropped by 14%. So a substantial decrease in a very short space of time. Compare that to an affordable suburb where we've had tens of investors over the journey, probably getting close to 100 even. Their median house price is up 2.6% in the same time. So again, takeaway, the median is an indicator of market activity. Just because the median drops doesn't mean that every house has lost value. And in reality, the reason why the median has dropped is because there's more activity at the affordable end of the market than the expensive end of the market, which is exactly what we would expect, when we've seen the first interest rate rises for 10 years, as people start to adjust to what that means and, lower demand at the high end of the market compared to the more affordable end.
Does it make sense at all? Because everyone gets sort of absorbed or obsessed by median prices, and that's their sort of North Star when making investment decisions. And it sounds to me it's largely folly trying to invest off the median because it makes no sense. It's like a fingerprint, right? Every single property is unique, and trying to benchmark it against something which is collective of everything is madness. Is that a fair statement? Yeah,
look, I think I'll answer that in two ways. The first way is that the Australian median makes no sense at all. The capital city median is a bit more of a relevant indicator, but you still have different property classes within a capital city. So the kind of natural tendency is to look at a suburb median. Now, this is where you need to be a little bit careful because it can be a really good indicator, provided that you've got a critical mass of sales activity. Because if you have, 50 sales, let's say in a particular area, then the median movement is going to be a pretty good indicator of what's going on. Conversely, if you have 5 sales in the same time period, then one high one or low one can make the median much more volatile. So, using the median as an indicator and then really drilling down to where can I buy for value around favorable comparable sales is the process that we really look at. And that's why, two of our research and analytics team are ex-valuers. That's exactly what they look at, is where can they identify value around, properties that are selling at higher price points. Because as we all know, we don't want to be just investing in one property. We want to be building a portfolio. And the most important thing to be able to do that is to be realizing equity on a bank valuation, because that allows you to get into your next one and your next one. So that's how I'd encourage investors to go about it.
And do you think, Matt, like this whole notion of a cooling market, do you subscribe to it, that there is some markets that are cooling, but it's not a universal catch-all for all of Australian property?
100% believe that there are some markets that are cooling. And as Michael pointed out, the expensive suburbs like Toorak and Mossman and others that are kind of at that, we call it the pointy end of the market, where it is actually a really thin market. There's not too many people who can afford to spend $5 to $10 million on a house. Those markets are the first to come off when there's a bit of uncertainty, or as interest rates go up or the share market takes a dive, because the executives who are would otherwise bank on their bonuses, or they start to get a bit nervous, their share portfolio's taken a hit. So they become a lot less active. So those markets at the pointy end really get hammered in these periods where interest rates are rising and there's uncertainty. But we always try to look through at what are the fundamentals driving a market. Obviously, affordability being one. And yes, as interest rates go up, then it diminishes affordability. Putting that in perspective, I just got a loan yesterday for a new property purchase. I'm paying 2.99% interest on that loan. And I was laughing after my banker left, because in my head, I'm still used to 6% interest being the norm. So interest is still very affordable relative to what it has been historically. As I said before, wages are going up. Wages don't go up universally, but certainly over the last 5 years, they have been going up on average 22% across Australia. And there's a massive undersupply of houses, even in markets like Sydney and Melbourne, which a year ago were well over 3% vacancy rate, still having seen a mass exodus of students and working visa holders who obviously left during COVID, vacated the CBDs and left a huge oversupply of apartments in those markets. That's really diminished now, and we're back to talking about how undersupplied those markets are and rents going up quickly. Again, it might not be the executive residences that are asking for $2,000 a week, but in that market where it's $500 a week to $750, and that's chronically undersupplied. And if you read the papers and look at local papers or city-based papers, there's almost a story every week about a family who's living in a caravan park or been forced to go and live in a tent or couch hop because they're just getting squeezed out of the rental market, even if they can afford to pay more. There's councils, I know in Queensland, councils writing to property owners who have listed their properties on Airbnb, and councils are writing to them to beg them to put those properties into the long-term rental market because of that chronic undersupply. And they know you can't just snap your fingers and create more housing supply. There's been massive planning constraints imposed by consecutive governments of state and local government that have led to this undersupply, and they can't turn it around. You can't build a 300 apartment building when costs are going up at the rate that they are, and there's uncertainty there. So this undersupply is here to stay for quite a while, and the interest rate, I guess, cycle that we're in now is likely to be shorter lived than a lot of people, and particularly in the mainstream media, are painting it to be, because we're already seeing a lot of the supply pressures that have led to inflation starting to come back. The price of timber, for instance, in America has halved since the start of the year. Price of oil is dropping, and a lot of other of those supply constraints that were brought about by COVID are starting to wash through. So, yeah, I think it's important to have that understanding of where we're at in that interest rate cycle. And it's not going to be a big window of time before everyone's back to going, oh my gosh, there's no houses in this country. If I don't want to just keep paying more and more rent every year or every 6 months when the landlord asks for another 10%, 15%, the only thing I can do to stop that is to buy a property, to get into the first home buyer market, for instance. And again, there's some great government incentives that are on the table right now to encourage first home buyers. It's a great time for them to be active.
One thing I'd just add to that, Phil, is, if we bring it back, Matt talked about the fundamentals that we focus on. I think it's important for investors to focus on the fundamentals as well. And really the fundamentals of a property investment is that the asset grows in value and it brings in cash flow at the most basic level. So, supply and demand in certain markets, absolutely there's growth potential there. But the number one thing that causes concern around interest rates going up is a tendency for people to think it's going to cost me so much more to service my mortgage. Now, if you're an owner-occupier that has a higher level of debt, then absolutely that's the case. As investors, though, if you're smart about what you buy, and we've talked already during this podcast around very low vacancy rates and the relationship that has with very steep rental growth based on supply and demand, we're seeing in several areas rent being up $100 to $150 a week on 12 months ago. So if you look at what the increase in interest rates costs, but you're also increasing your rent substantially, and if your interest cost is going up, then it gives you more tax deductions, then very rarely is an investment property actually costing the investor any more out of their pocket if they've bought the right kind of asset from a cash flow point of view as well. So I think it's, fundamentals are, buy for growth, but make sure that you're not impacting your out-of-pocket cash flow in the process.
Yeah, and probably one other thing that comes to mind, and I'm not a player in the share market, but I find Warren Buffett obviously an incredibly insightful human being, and obviously he's been very successful as an investor. And I was reading something that he said recently, and I'm not sure if you guys would recall, but it was about a year ago he was getting hammered for having something like $120 billion in cash that Berkshire Hathaway had in the bank. And he said, I can't find any good investments. And in the last 6 months, while the share market's going down, he started to buy and buy. While everybody else is bailing out, he's getting in. And it comes back to that old saying, be fearful when others are greedy and greedy when others are fearful. But his rationale is that if you think something's good value at $1 million, then surely if it's $900,000, it's even better value. And a lot of people think when the market's going up and people are paying inflated prices, that's the time to get into the market and capture good value. I've always found that I actually have the most success in acquiring when the market is a little bit softer, where there's a little bit less competition. Means I get to pick and choose more carefully the investments that I want, and they're the ones that long-term prove to be the best performers. And if we wait too long, and I learned this lesson early, if I waited too long to then get in, I ended up paying more for the one that I wanted, or the ones that I wanted were gone and I had to be a little bit less picky and just take what was available. So this concept of waiting to time the market, I mean, if you're waiting for it to go up, you've already lost growth.
Yeah, there's so many moving parts to all of that. And I've been sort of following a lot of Buffett stuff recently, and another key thing you say, don't buy crypto, right? He's been scathing about that, and this is what's happened there. But the big question is then, and you sort of largely answered it, Matthew, is whether it makes sense to buy right now. And I want to sort of unpack that a little bit more. We'll just go to a break. Stay with us, everyone. Back in a moment.
Ever wondered how you can invest like the top 1% of Australian property investors? Henderson Advocacy has been at the forefront of helping everyday Aussies improve their financial freedom. So if you're a savvy investor or someone just starting out on their property journey, give Henderson Advocacy a call today. Head to www.henderson.com.au. Don't invest alone. Invest smarter.
Welcome back, everyone. It's Phil Tarrant, host of the Smart Property Investment Show. I'm with Matt Lewison, his CEO, and Michael Beresford, Director of Investment Services over at OpenCorp. Now, before the break, there was a whole bunch of info. We got days and days of podcasts around it. But Matt, you were talking really quickly around what's going up in Brizzy around a rental price, and it sort of lends itself to what Michael was saying around upwards pressure on rents to try and counterbalance increases in interest rates for property investors. So different for owner occupiers, different for property investors. I see the Lord Mayor up there is going to charge extra tax on people who have their properties in the short-term rental market. But I also note, and this was news out the other day, I don't know if you can give me some sense for it, that they're now going to start charging land tax to Queensland property investors based on the collective size of their portfolio right across Australia rather than just the land tax in Queensland. Are you across this? Have you heard
We've just started to try and wrap our heads around it. To be honest, it's kind of something that we've always sought to manage through diversification as well. Obviously, if you have too many properties in one state, your land tax base goes up, you shift it elsewhere. There's also discounts that you can get for having a trust. So obviously, you tend to pay a premium on your land tax per property if you have a trust, but you don't have your properties across your portfolio. If they're in different trusts, you don't get aggregated to pay a higher overall land tax base. So there's a few things that we're looking into to see whether they're still applicable, how to make sure that we're managing land tax to the best of our ability. And there's a range of different things that...
I was looking at it going, we'll do a big follow-up to everyone on smartpropertyinvestment.com, but it just seemed as though Queensland was trying to discourage property investors from buying up in Queensland because they want to make the homes available for Queenslanders. So anyway, outside of this, but the question is, Matt, and I think you answered it, it actually makes sense to buy now. The smarter investors are actually buying in a cooling market. To your point, if they saw value at $1 million and it's now 900, why would it be any different? Because you only need to look at the long-term trajectory of Australian real estate. There's a pretty good likelihood it'll bounce back to where it was at some point in time. And what I'd like from you is some sense for how long you think this downturn will be. Are we 6 months into a 12-month downturn? Is it an 18-month downturn? How quickly do you need to move in order to buy on the way down so you can get the full carry on the way up?
So we're almost 6 months in already since Sydney prices in particular peaked, and Sydney's 30% of Australia's property market. So if Sydney and Melbourne peak in kind of February of 2022, then theoretically the Australian house price median has peaked at that point in time. Because it doesn't matter how aggressive every other state goes up in value. If Sydney and Melbourne median is dropping, then it will drag down the Australian median. So we're close to 6 months in already. They typically, as in a softening period or a downturn, typically runs for 6 to 12 months. And that the interest rate tightening cycle can run for a lot longer than that. We don't forecast that this interest rate tightening cycle will run for longer than a year. We think kind of towards the end of this year it's going to peak as a lot of that, the supply side pressures diminish through the system in terms of what's been driving inflation. And as inflation comes down, then interest rate movements will obviously slow down or diminish as well. And then I guess when you look at it for Australia, there's as we've talked about, there's such a housing crisis at the moment for rental accommodation that it's unfathomable that this softening of the median house price can last for very long because of the fact that there is so many people in the rental pool who are in crisis levels that typically we find, if we think about the rationale, I mentioned this earlier, if you don't own a property and your rent's going up every 6 months or every year, you become even more motivated to buy a house. A lot of people whose parents might already own property and have equity see their kids' rents going up. And I've seen this over the last 20 years happen so many times that when the rent's going up regularly, the parents start to step in and go, hey, maybe we can buy you a house or we can help you to get into the market because I'm tired of seeing this money go to waste getting paid to a landlord. If you can pay your own mortgage, then that's a better outcome. So we start to see this shift of renters trying to become first home buyers. Now, keep in mind, we've got this housing shortage and we're only just starting international migration again in the last few months. And there's talk of pushing that up. I saw an article today that in the upcoming Prime Minister's Forum for Business, that the discussion is going to be around lifting the immigration intake for the next 2 years above historical levels. I think there's something like a 500,000 worker shortfall in Australia right now. And the only way to solve that without bringing kids straight out of high school and skipping university is to bring them in from overseas. And again, where do they go? Well, they're going to have to rent. They're not going to come in and buy straight away. They'll be on 2 or 4 year visas. That's going to add even more demand to that rental market where there's very little opportunity to increase supply around the capital cities because of the high cost of construction for apartment buildings and townhouses. So when you have all of those forces, you go, well, once the market wraps its head around interest rate rises, and we always see, as soon as they start going up, everyone panics. Everyone goes, what's going to happen? The media starts to run rampant. There's 10 articles a weekend about interest rate rises. Then once people settle on that concept a little bit, they realise that their rents are still going up. They realise all these other things are happening and the floor hasn't fallen out of the market. They go, actually, things aren't too bad, and they start to invest again. So we actually see like a 6-month kind of pause. Saw it through the 80s as well, looking back at the data when inflation was really high and interest rates just kept going up for the whole decade. And the first 6 months, there was a pause, and then prices actually ramped up faster after that, which is obviously why the RBA also had to keep ramping up interest rates because they just kept chasing the house prices and inflation. So we don't think this is a very long window of time. We're halfway through, if not more. In the next 6 months, we think things are going to start to turn around and people will realise that perhaps missed the opportunity to get in when there was a little bit less competition and they're having to fight harder to buy a property again.
Yeah, well, good economic lesson and insights, Matt. I appreciate that. And there's, again, a lot there to try and unpack, but it's a very good sort of a holistic view of how that works. So the point then is, Michael, and you mentioned it beforehand, I think we're all agreeing that you should be looking for opportunities in the cooling market. That's where the smart investors operate. But the point being that you want to identify an appreciating asset that gives you increasing yields over time. So you need to be looking at the inherent investability of the different asset classes and the locations where they're based. So what drives stability and growth in these areas which are investable? And I think we probably all agree there's areas of Australia which aren't investable, and we typically don't talk about them, but they'd be sort of, one industry towns which are relying on, one company, one industry, all that sort of stuff. So give us sort of 3 or 4 points of stability to support growth and frame investment decision making.
Sure. So I'd bring it back to the 3 fundamentals that Matt talked about before, Phil. So supply, demand, and affordability. To your point around a single employer town, there's generally going to be a fair bit of space around there. So they could bring on endless amounts of supply, even if the demand increased. So that dynamic's not working as well. Plus the demand is fluctuating with the workforce coming in and out, being quite transient. So if we look at the major population centres, that's the best place to start. So cities that have population of over 200, and within that, we look at, existing suburbs. How do we minimise the supply in particular areas and make sure that we haven't got, years and years of land supply that could potentially come on and diminish price growth as a result? Because as soon as we get the supply and demand dynamic working for us the way that we want, that's when we see the upward pressure on rents and then the upward pressure on prices that naturally follows as, landlords, assuming they have a deposit, don't want to be paying more rent. They then become buyers and put upward pressure on existing house prices. So they're the first two. And then obviously affordability is just a byproduct of driving demand. So the pointy end of the market has relatively fewer people that can afford it. The affordable end under the median house price has predominantly more people that can afford it. Yeah, and I think that's backed up in some of the data that we've seen recently, where in the last 12 months, Queensland and WA have had 90% of the nation's population growth between them. Queensland at 57%, WA at 23%. Sorry, that's 80% of the population growth. Because those two capital cities are far more affordable than a Melbourne and definitely a Sydney median house price. So, when you really distill things down to the fundamentals, rain, hail or shine, depending on booming markets or cooling markets, that's a really good recipe, because fundamentally supply and demand is what drives all of the essentials that we need for good investment. Yeah,
probably one other thing I'll just say as well, the audience probably heard us talking about supply and the supply shortage. Now, it's really important to understand that there's two different types of supply. There's short-term supply and there's underlying supply. And what we talk about when we talk about underlying supply, I mean, how many houses are there in a market? How many houses are there in the city? And the only way to create new houses or new dwellings is to build them. Whereas short-term supply relates to, in a local market, how many people decided to sell their house that week. That can change, obviously, reasonably quickly. And people can go, oh, I'm going to bail out of Toorak, for instance, or I might my trophy home on the market, so I think the market's peaked. If 24 people decide to do that in Toorak, then the supply of trophy homes in Toorak's probably tripled for that period of time. But what hasn't changed is the number of houses in Toorak. And obviously, when we look across the market, it's really important to understand the market's ability to deliver new dwellings. And this is why when we focus at the affordable end of the market, the only way to really move the bar that might result in rents coming down or in prices actually ever coming down is to build a heap of new dwellings. And you just can't do it. We can obviously add some, but if the number of new people moving into a market exceeds the number of houses getting built, then obviously the supply of available properties is actually diminishing in that market, even when you're building new properties. So that's important that everybody understands that difference between short-term supply and underlying supply.
So again, it's a bit of a mindful to work out what next for those people who are finance ready and can actually capitalise on this market. We'll get into that. Let's go to another break. Stay with us, everyone. Back in a moment.
It's time to get help. Interest rates are increasing. Inflation has hit an extraordinary 5.1%, and the chance to secure a golden egg property is getting narrower by the day. Dragan from Buyers Agency Australia has been presenting the facts and helping property investors make smarter, well-informed, educated decisions in property for years. So what are you waiting for? Get in touch with Dragan today at www.buyersagencyaustralia.com.au. Invest with integrity.
Welcome back, everyone. It's Phil Tarrant, host of the Smart Property Investment Show with Matthew Lewison and Michael Beresford from the guys and girls over at OpenCorp. Now, what do you do about all this? And you guys have shared a lot of information to, I hope, help frame people's attitudes towards the opportunities tactically of investing in the cooling market. And I'd like to think that most people tuning into this podcast probably aren't the people that get obsessed or absorbed by what the mainstream media says. I'd like to think they're investing in their property education, and therefore the idea of investing in a cooling market isn't a new thing for them, but a lot of people get confused about it. And you must hear all the time, Matt and Michael, where people go, yes, I want a negative gearing strategy. That's the strategy that I want. Can you please help me with the negative gearing strategy? What do you say about that, Matt? Or do you still hear that?
Oh, we do. And we hear a lot of questions around, should I negatively gear or should I positively gear? I'm not sure. And again, that shows that there is a degree of misunderstanding about what negative gearing is as well, and how negative gearing can obviously provide you with positive cash flow, and understanding the differential between that. But I must admit, Michael's probably more in tune with what the customers are saying, as he's he's talking to people every day, whereas I'm a little bit behind the computer, looking at data and dealing with the research team.
Do people yet understand, Michael, what negative gearing is, or they're still...
A small percentage, Phil. So I think what's confused is positive gearing and positive cash flow. So it's not well understood that a property can be negatively geared, i.e. qualify you for tax benefits. But when you put those tax benefits on top of the rent, actually result in a positive cash flow outcome for the investment. So if I take your original question, the guidance that we give our clients is exactly the same as that we've been giving them for nearly 20 years. And that means that you need to start by understanding what you want to achieve. So the only reason why personally I invest in property and why I love helping others invest in property is because the safest and most secure way to create significant wealth is through compound growth, and property is the best way to achieve that. If there was a better way, i.e. buying sunglasses, then I'd be able to talk to you about Ray-Bans, but there's not. So that's why we invest in property. The second part obviously comes to making sure that the cash flow is really strong to allow us to be able to build the portfolio, because one property bought 15 or 20 years ago would have got that investor a great outcome. Imagine if there were 3 or 4 or 5. And those results are magnified when you look at the size of a portfolio. So really the cash flow comes down to how can I hold my portfolio over the long term, while at the start, it doesn't impact my lifestyle and allows me to be able to build property on property, but over time starts to create a positive cash flow as well. So, to the people out there that are thinking about what the next steps mean for them, revisit and be really clear on your goals. Once you are really clear on your goals, what do you need to be doing from a strategic perspective to achieve those goals and in what time frame? And make sure that you keep focused on the assets, the types of property that are going to deliver that outcome for you, as opposed to, getting derailed with, interest rates go up, I need more cash flow, or whatever it might be, because we don't subscribe to the fact that you need to sacrifice cash flow for capital growth, and you don't need to sacrifice capital growth for cash flow. We believe that you can have the best of both worlds. And that's how and why we're able to help our clients build substantial portfolios over a long period of time.
As you know, Phil, we're pretty passionate about data, not just from the market, but also our own data. And we're constantly looking to see what we can do better and how we perform. And we track our performance and our clients, the portfolio of our clients' performance against the market. So we get data from the Real Estate Institute of Australia that tracks the, obviously, house price movements per capital city, as well as the average yield of properties within markets. And the average yield of investment properties in Australia is about 3.1%. When we did our most recent data, which was at the end of June, we actually found that our median yield is, I think it's 4.6%. So when you compare that to the 3.1%, again, it's just about making smart decisions. That's about a 40% increase in terms of cash flow that an investor is going to get from having the right type of portfolio over the average. And the total return was 11.7% per annum before any benefits of gearing. So if you've got better cash flow and you're also obviously in a market where you're picking the right properties to go up fast, then you're able to duplicate faster, and the benefits, as Michael said, are going to be compounding for the investor. But it's really important to get that balance right between cash flow and capital growth, while also making sure that you can get into the market as early as you can. It's something my dad really drilled into me. That's why my brother and I pulled our money and we bought when I was 18 and Al was 20, because Dad said the best time to get into the market is as soon as you can afford to. And we saved like mad, and I'm glad that we did get into the market in 1998, because over the next 2 years, price of property went up about 60%, even though it was forecast to crash when the GST came in. And we wouldn't have been able to get into the market for years if we hadn't have got in at that point in time. It would have taken us a lot longer to save our deposit. And then that
sort of gives sense to the cooling market we're in right now, and just the baseline premise, Michael. Why is it important to get the right property in the right area, the right market, regardless of cycles? It's a downward cycle. Last time we got together and we've been chatting about this, guess what? Property goes up and down in value. That's what it does. It doesn't operate in a linear fashion. So the old maxim continues. It's got to be the right property, the right place in the right market at the right time.
Spot on. Yeah. Take a long-term view, buy when you can. We're not trying to, make money in the next 2 weeks with our property investments. And, quite often by the time the media start telling us the market's moved, as Matt said, there's growth that we've missed out on. So ensure that you've got properties that are low cost to hold, so they're not impacting your lifestyle while we hold for the long term and get the benefits of compound growth.
So how do people get the benefits from your experience then, Matthew? It's challenging to buy right in all markets, but in a cooling market is where you really want to probably phone a friend and have someone running in parallel with you to support you on those decision makers who've been there before. You're getting a lot more people sort of calling up you guys saying, hey, I need help because I'm unsure, because there is so much uncertainty right now.
Still getting plenty of people coming through. Obviously, the uncertainty and the noise that they've been hearing before they speak to us is probably amplified to what they might normally get. One of the great things that I see is how many of our existing clients are referring friends. I think it was something like 70%. I think last year, wasn't it, Michael?
73. Yep.
Of all of the people who we helped to buy an investment property last year were either repeat customers or referred by our existing customers. And it shows that people who have been investors, who have made money, understand that even in these times, it's still a great opportunity to get into the market, and the need to have really solid advice from experts as opposed to running your own race. I'd say probably for anybody who's thinking about and maybe hasn't started investing, or even it maybe has one or two investments and not sure what they can do next because of, I guess, the interest rate outlook, and then not sure what that means for them. The best thing is to do would be to speak to a finance specialist as well, get a sense of what your borrowing capacity is now, including any buffers and any forecasts for changes, because it might surprise you. And if you have the capacity to buy and you're uncertain whether you should wait until maybe you feel like the market's bottomed out, I guess be aware that not all markets are going down. As we said at the start, some markets are actually going up. They may be the markets you want to be in, not the one that's on its way down. So thinking, hey, I'll wait until it bottoms and then I'll get in, go, well, aren't you better off to be in the market that's going up already and has really solid fundamentals? But putting all that aside, I always kind of think back to a friend of mine who years ago told me that they wanted to wait until prices went down a bit further so that they could get in to the market. And they missed it on one cycle because they just mistimed it. And it was 5 years later when they're having another crack at it. And I said to them, if prices drop another 10 grand after you've purchased, in 10 years' time, are you really going to care? Because we've seen in the last few years, we've got clients who have made over $1 million in the last 6 years alone. And it wasn't a pretty time for all property markets in Australia. Some of them were really hammered by the tightening from APRA and the financial regulation that was imposed through 2016 to 2019. And they still made $1 million through that market period because they got in and they acted and they're in the right markets. And again, even if they mistimed it, and if I kind of use that as I play devil's advocate, let's say they overpaid 5 grand or 10 grand for their first property. Do you reckon they're losing sleep today, having made $1 million in less than a decade, just from being in the market? And they weren't doing anything fancy, just making smart decisions. We're putting them into places where there was a good quality cash flow. There was a shortage of houses. Rents have been going up and prices have been going up. It's not rocket science. There's a pretty well-trodden path here, and it's just about staying on the path.
It's well observed, and every single property investor I know, myself included, when you ask them, what would you do different? They go, I wish I started earlier, and I wish I did more when I could have, because I probably could have and probably rode that wave that you're talking about. But again, it comes down to asset selection and why you should be looking towards the professionals. What's the best way to get in touch with you guys if anyone wants to reach out and see if you can help them out?
Yeah, the best way to do that, Phil, jump onto our website, opencorp.com.au. You have a look at what we do there. Click on the button that says request strategy session, and one of our team will be in touch to understand what it is that you want to achieve and explore how we can possibly help.
Brilliant. Matthew Lewis and Michael Beresford, thanks for your time today. I do enjoy it. Look forward to catching them again soon.
No worries. Thanks, Phil.
Good to see you, Phil.
See you guys. Hope you enjoy that, everyone. Remember, smartpropertyinvestment.com.au, social media, if that's how you like to get your info, Smart Property HQ. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
It's safe to say the property market has been red hot over the last few years, with some of the markets we've selected in 2021 rising over 40% in a 12-month period. It's very likely that if you're a property owner, your property has gone up 20% minimum in value in the past 12 months, and you have most likely accrued sizable equity that can be recycled and extracted to build your investment portfolio. With interest rates increasing, you might be wondering where to invest to maximise capital growth and cash flow in 2022 and beyond. Well, to save you time, energy and guesswork, award-winning author and regular guest on the Smart Property Investment podcast, Paul Glossop and his team at Pure Property Investment have outlined the top 30 affordable suburbs poised for strong capital growth over the next few years with sound cash flow. Grab your free Top 30 Guide to Property Investment guide today at purepropertyinvestment.com.